today, live from studio, we're joined by Mr. Amit Goel, who's the co-founder and Chief Global Strategist at Pace 360. Welcome to the show, Amit. My first question to you is that, we are expecting a Fed rate cut soon. What kind of, in terms of quantification cut are you expecting, and how quickly are you expecting that?
Firstly, thanks for having me on. So, see, if we talk about the markets, then the probability right now is that there is going to be at least a 25 basis cut, which is almost like 100%. And there is about a 32-33% probability for 50 basis points. I'm of the opinion that it's going to be 25, while the recent data which has come out in the last few weeks is very suggestive that Fed would have to get aggressive at some point of time in the next few months. But I think Fed would probably gravitate towards a 25 basis points, just like they did a 25 basis points hike in March 22, while there was pretty strong evidence that the inflation is here to stay, and it was really beyond the comfort zone of Fed. So similarly, I feel that while the data is very suggestive that Fed should become very aggressive, but probably they'll start with 25. They will see how things go for another few weeks. And then maybe at some stage in the next few months, maybe we get a 50 basis points cut. But considering that the economic data, while it has been on the weaker side, but it has not been so weak that Fed should get into some sort of an emergency or an urgency mode. My sense is that they'll begin with 25, but at some stage, maybe in the next 6 months, we may expect a 50 basis points cut as well.
So cumulatively, you're expecting a 50 basis points cut over the next 6 months or so. Is that the right way to approach it?
Slightly more than that. So markets are discounting more than 6 cuts by March.
Exactly, yes.
Which is a huge number.
Yeah.
Somehow, considering the fact that the economy is not that weak, I don't think we'll get a negative GDP reading in a quarter, at least for the next maybe at least 2 quarters. So my sense is that they will not do that kind of aggressive cutting that they cut 6 or 7 times by March. But we are expecting about 4 rate cuts by March of 25. And we do expect that by September, October of 25, Fed will be a lot more aggressive in the rate cutting, because we sense that US could get into a recession sometime in the middle of 25. If that were to happen, and if we get a negative GDP reading, or if we get a negative growth jobs reading in a particular month, I think Fed will become pretty more aggressive, and maybe by October of next year, we get something like 150 to even 200 basis points of cuts. But by March, we are not expecting more than 4 rate cuts.
Interesting. Sure. And so then what do you expect? Like, considering all of these trends, of course, you're saying that up to 200 basis points rate cut, of course, from a long-term perspective, do you expect RBI to follow the same?
RBI probably doesn't have that kind of leeway, because we must bear in mind that the repo rates in India went up by only 200 basis points, while US Fed took up the rates by more than 500 basis points. They actually took it up by 525 basis points. So on the way down, I think Fed probably by 2026, we expect that the Fed fund rates would come down to 2%. So we are actually looking at a reduction of almost 300 to 325 basis points by 2026. Okay. But I doubt that RBI would go below 5.5%. So we are looking at 4 rate cuts in India, for maybe about 12 rate cuts in US over the next 2 years. So which means that for every 50 to 75 basis points of rate cuts in US, you should not expect more than 1 rate cut in India. So our expectation is that the repo rate comes down to about 6% by, let's say, April/May of 25, and by 2026 middle, we expect RBI repo rate to be around 5.5%, but not much below that.
All right. And Amit, with regard to the spread between the India and the US bond yield, before we go, into the impact on markets itself, just the spread between India and US, historic lows, does that continue?
Yeah, so that's a brilliant question, Harsh. So if I look at 10-year bond yield, for example, US went up to as high as 5% last year, October, and we did not go above 7.4, 7.5. So at that point of time, when US rates were at their highest, the spread was about 250 basis points. Right now, the 10-year in US is about, let's say, 360, 365, while we are at about 684 today. So that spread is, let's say, it has gone up. So we are at more than 300 basis points. So we are at about 320, 325 basis points as we speak. My sense is that this spread will actually go up because the rates will fall lesser in India than they would fall in US.
Yes.
Just the way that on the way up, US rates went up from 1% to 5% for a 10-year yield, while we went up from 5% to 7.5%.
Sure.
So similarly, on the way down, India will go down less, which means that the spread between India and US 10-year bond yields is actually going to go up over the next 1 to 2 years.
How much, Amit, if I can just briefly touch that?
Yes. So we are looking at 10-year bond yield to come down to about 2/4 by 2026. And we do not think that Indian 10-year at that point of time would be less than 6.1, 6.2.
So 6 will still continue to be that cap. Difficult to kind of breach that.
Yes. So,
Okay.
I think you would need a protracted recession in US, and you would need the rate cuts to happen pretty aggressively, and you would need the rates to remain low for an extended period of time in US for Indian bond yields to go below 6%. Otherwise, we are assuming that by 2026, we may come down to 6.1%, but not significantly below that.
Sure.
All right. So, Amit, now I want to understand that, where are you investing currently? And I also want to understand that when it comes to alternative assets, what is the best way to play that theme? Like, which are the best pockets to invest in?
So when you talk about alternative assets, you mean to say non-equity assets?
Right.
Okay, fantastic. So we have been very, very bullish on gold for the last 2 years. And gold has gone up from $1,612 to about $2,500. So it's gone up by more than 50% in 2 years' time. And we have been very bullish on long duration fixed income, sovereign bonds, both in India and in US for the last 1 year. And the returns have been pretty extraordinary there as well. But the sense which I get is that market has become a bit too dovish over the last couple of months. So when the market is expecting 6 rate cuts in US by March, I think the market may be a little disappointed at some stage in the next few weeks and months. So we are actually in the process of reducing our duration. Not because we are not bullish on fixed income for the long term, but we believe that this fall has been pretty swift and fast, and we may become sideways in the long-term bond yields for some time, and that is in spite of the fact that Fed is going to do a rate cut next week. But in spite of that, I think the bond yields do not have too much to go down over the next 2 to 3 months. So what we are now doing in our portfolios in India and globally is that we are actually reducing our exposure to gold. We are actually reducing our exposure to long-term fixed income, both in India and in US. So we are booking some profits there.
So only short-term debt, Amit? Sorry to interrupt.
Yeah, so short-term debt,
what you're
because
looking at?
we must realize that the carry is very, very negative. So in US, the short-term rates are 5.25%, 5.3%, and the 10-year bond yield is at 3.65%, right? So there is a negative carry of almost 160 basis points. If I look at India, your 10-year GSEC is at, let's say, 6.84 as we speak, while your ultra short and your short-term, your money market funds are giving you about 7.6, 7.65. So the negative carry is about 80 basis points, and because we invest a lot of money in corporate bonds, and there the yields are easily 9.5 to 10%. So the negative carry is almost 300 basis points if I were to compare the 10-year GSEC yields with the corporate bonds. So what we are doing is, we are trying to enjoy a higher carry right now, reduce our exposure to gold, reduce our exposure to long-term fixed income, with the intention of getting back into them when the market is somewhat less sanguine about the rate cuts. Now, coming to your question about alternative assets and about where we are now positioned. So we are actually sitting very low on equities at the moment, because not just in India, but globally, I feel that equities are pretty highly valued, and the markets are not taking recession as a very serious possibility over the next 3 to 4 quarters. While we differ in our assessment, we believe that the chances of US getting into a negative GDP growth rate quarter is extremely high, as high as 70 to 80% over the next 3 quarters. So our assessment of the global macros is a little different from the way markets is assessing it, which is why we find the current valuations way too high if the US were to actually go into a recession over the next 3 to 4 quarters. So we are low on equities. So right now we would just enjoy the short-term carry, which is still very attractive in India, very attractive in US. And we will get back into fixed income long term. We will get back into gold once there is a little bit of cool down. And we will also buy equities when there is a relatively deep correction, just like we saw in early August, when there was a swoon in the markets, there was a yen carry trade reversal, and Nifty went all the way down to below 24,000, and we increased our equity exposure in India dramatically at that time, and similarly in US. But we have booked profits on most of those positions over the last few weeks. And we will be looking for next such opportunity in the next few weeks and months.
Right. And Amit, if I can just very quickly get your take. Gold versus silver, just one word.
I would definitely say gold.
Gold. Okay. Thank you so much, Amit. It's been a pleasure. But with that, completely out of time on this edition of the SMID show. From Mahima, myself, thanks so much for watching. Thank you, Amit, for coming in.